Hello, everyone. This is Mike Wilkerson. I'm the founder of Stormwall Advisors, the host of Stormwall.com, and the author of Why America Matters. Coming to you today with the Stormwall Advisors monthly update for June 2024. You're watching this on my YouTube channel. Please don't forget to give it a like, share it. If you're not subscribed to the channel already, please do so, and turn on the notification bell. I want to jump into a topic that there's been a lot of debate about recently, which is how strong is the U.S. economy. We saw just this week, it's early June now, jobs numbers came out yesterday. On the surface, they look pretty good. Job numbers up above expectations from the establishment survey. On the other hand, unemployment was also up. So what's going on here? And at the same time, we're seeing the stock market continue to hit all-time highs, getting higher and higher, whereas on Main Street, things are not as good as represented. So as per usual, what I do here, and also for audio listeners, is I'm going to go through a series of slides. I'm going to pop over to that just now, and then I'll come back at the end to share a few more thoughts. So here I go. I want to share this share the screen. Bear with me while I do that. All right, and there it is. Is that working? All right, there we go. Not quite what I wanted, is it? Let's get this down. Okay, so I'm going to move myself out of the way. Let's go through this quickly. So the question is, how strong is the U.S. economy? So we've seen, actually, if you look at the most basic measure, which is GDP growth, that we've been on a downward trend for a while. So coming out of lockdowns in the fourth quarter of 21, GDP posted gains of 7% as the economy reopened. And then going into 2022, we had two negative quarters. So technically, the U.S. economy was in recession. People debated it at the time whether this is real or not. But after that big reopening, and then during 2023, there was a lot of discussion, end of 2022 and 2023, about the health of the economy, where we're going into another recession. The year ended up pretty strong with almost 5% GDP. And then we see this year a deceleration. So the fourth quarter growth slowed to 3.4%. The first quarter of 24, a very anemic number at 1.3%, so barely growing at all. And for the full year of 24, estimates are around 2%, with the second quarter ranging from 1.5 to 2.7. Now, the U.S., not surprisingly, is well below the BRIC countries and other growing markets. The U.S. has been in maturity for a long time, but this belies some of the real weaknesses and the structural issues that are keeping growth back. So what you're seeing here is basically all of the BRIC countries, with the exception of Brazil, which is also roughly growing at the same rate as the U.S., and South Africa, which has real structural problems and problems in their energy markets. India, Iran, China, Russia, all growing and outpacing the U.S. And over the long run, that is going to hurt our strategic advantage. At the same time, we see that inflation continues to persist. The May 2024 numbers aren't out yet. It'll be about another week. But what we saw in April was an uptick. So we had headline inflation at 3.4, and core, when you exclude food and energy, was up 3.6%. So we're a long ways off from getting back to price stability. And this is continuing to bring distortions into the economy. If you look at the total price increases over the 4 years of the Biden administration, headline CPI prices are up 22%. And even when you exclude food and energy, core inflation is up 20%. And a lot of that has to do with shelter and housing, which has been very, very strong over this period. One of the negative signs that makes me concerned about how strong the U.S. economy really is we've seen pretty consistent decline in the, what's called the ISM manufacturing PMI, Purchasers Managers Index, which is a gauge of how business activity is progressing. And what the May results showed was a decline from April, and also well below the estimates, which had anticipated a slight improvement. And we end up with indications that manufacturing activity was slowing on the back of soft demand, pretty accommodative inputs. But not only was the overall index down, but new orders declined, inventories fell, backlog of orders fell, and production also slowed. And we haven't seen post the COVID reopening, the opening from lockdowns, really the kind of economic strength on the manufacturing side that we saw during 2017, 2020, the Trump years, where there was a lot of progress made on our manufacturing base and on trade policy under Secretary or Ambassador Lighthizer. So, and I think important to note, this next slide, the U.S. consumer is basically running out of steam. I've talked about before that over the last year or so, the U.S. consumer has been maxing out on debt, while at the same time depleting savings. So as of the first quarter of 24, U.S. household debt is now at an all-time high, $17.7 trillion at the end of the quarter. And mortgage debt is up, yes, but non-mortgage debt, which is auto loans, student loans, credit cards, this is growing quite a bit. So credit cards are up 13% from just a year ago. And at the same time, we're seeing delinquency transition rates. That is the number of accounts, loan accounts, credit card accounts that are moving into non-payment. So they're in transition to delinquency, rising across all these debt categories, which says that the consumer is increasingly in trouble and unable to meet their obligations. This is also reflected in the inverse of debt, which is the savings rate, which has fallen to 3.6%, well below big numbers during lockdowns when people were saving, not spending, and actually starting to trend towards lows that we only last time saw in the couple of years right before the global financial crisis, when households got very extended on real estate and otherwise. So these are all negative trends that says the consumer, which has traditionally been one of the mainstays of the U.S. economy in the past few decades, is running out of steam and unlikely to be able to support continued growth. One of the reasons that we've talked about here before is that housing is more expensive than ever. We've seen increases in the shelter component of CPI continue to increase. It's roughly 6% over the past year or so. The housing prices is more expensive than ever, with a big increase in the post-COVID years, basically going up by 50% on average across the index that we show here. So basically pricing many buyers out of the market completely for a new home, either first-time buyers unable to enter the market, or those who are in starter homes unable to trade up as their families expand and grow. This is in itself a very big drag on the economy, and is a warning that we're seeing a big disconnect between the value of financial assets and how people are doing. So let's shift to that. How are people doing in jobs and employment? So the narrative this year has been that we're in a very tight labor market, that's one of the things that's fueling continued inflation. And on the surface, there appears to be some truth to that. When you look below it, and I have to just pause and give Zero Hedge credit for this, because they have hawked this all year long, actually for the past year plus. The pseudonymous author Tyler Durden has pointed out, in a comment that Biden made about how great the economy is under Bidenomics, that inflation is at the lowest it's been in 3 years. Wages, wealth, and jobs are higher than they were before the pandemic. And Zero Hedge, Tyler Durden, fact checks this and says prices have never been higher and are starting to accelerate to the upside again. All the jobs created in the past 2 years have been part-time. There's been zero job growth for native-born Americans since 2018. All jobs have gone to immigrants, mostly illegal. And real wages have not only been negative for most of the Biden presidency, they just turned negative again. Now, this was a couple months ago, but we have an update just as of early June in what Zero Hedge calls the most ridiculous job report in years. And this was mentioned before, but if you look at all of the jobs created over the past year, 1.5 million part-time jobs, 1.2 million jobs, full-time jobs lost. So the job creation narrative here is a myth. It's accelerating. If you look at what happened just in May, 286,000 part-time jobs created, 625,000 full-time jobs lost. This is a real issue, and indicative that behind the surface jobs numbers is a real problem. Higher paying, higher quality full-time jobs are being lost, being replaced by part-time jobs, presumably at lower wages. Now, Zero Hedge has also been one of the first, now others are catching on to it, to point out that these jobs are going to non-native born, to immigrants, most of them illegal. We've seen over the past 3 and a half years of the Biden administration that we've had somewhere approaching now 10 million illegal immigrants across the southern border. This has been the source of job growth. Even according to the Bureau of Labor Statistics' own data, the jobs created since December 2019, 3.5 million have gone to foreign-born workers, whereas native-born workers have actually lost over 800,000 jobs net in this transition through the Biden administration. Now, JP Morgan, the chief U.S. economist, Michael Ferroli, tries to describe this as follows. More immigrants means more labor supply and more consumer demand. It's possible that we could have a situation where employment growth is strong, but labor markets are looser. Part of the narrative here has been, oh, this is actually good for the economy because these these new workers create demand. You know, they're buying products and services, et cetera, but they're pushing other people out of jobs, especially on the lower end of the market, pushing out Americans on the lower end of the market. And this is creating a very unstable situation. Now, we see it in May's unemployment statistics, which just came out yesterday. May's number 4.0%, still not too bad by historical standards, but way up, 17.6% from April of last year, and now above 2019 levels during the Trump administration, pre-lockdowns and all the negative effects that lockdowns had on our economy. Unemployment is rising again, and real wages are flat. So in other words, what someone's taking home on, in this case, it's weekly real earnings, wages and salaries, workers 16 years and older, basically have made no progress in real terms, meaning after inflation, since before lockdown, since the beginning of 2020. Now, part of this has to do with people are losing jobs on the higher end, higher paying, as we've talked about already, taking in lower paying jobs. So there's a lot of distortion in what these numbers are showing. But overall, I think the main point is that the employment market, labor market is nowhere near as healthy as what the headlines are showing. So let's move on to the health of the banks. I've been talking for almost a year now, actually over a year, around the situation in the U.S. banking system. I've been vocal to say that I do not believe the banks are okay, that there's a lot of embedded risk and problems. We see in the first quarter of 2024 that unrealized losses on securities across the system grew by 8% to 517 million. It's been high and elevated over the past year. You know, we saw last year in the first quarter, this is when we had Silicon Valley Bank, Signature, other banks go into a failure, into crisis. Unrealized losses grew over the next couple of quarters, came down at the end of 2023, and now are rising again. These numbers will remain elevated so long as interest rates remain high. And if you look at what's happened, even if you go back to the financial crisis, we did not have, oh, hold on, I'm going the wrong way. I'm going to back this up. There we go. We did not have unrealized losses anywhere near. So this is 2008. You see that the number, the total aggregate amount of unrealized losses on investment securities never breached 75 billion. Today, as we just saw, it's over 500 billion. It's been as high as almost 700 billion. And this is across the system. And what this basically means is that these banks are sitting on these securities. If they had to sell them today because they need to raise capital, they will take a loss, which of course then creates a vicious circle of losing profits and capital along the way. The banks are responding, and they're responding by cutting lending. So in the first quarter, total loans decreased across the system, mostly out of the large, too big to fail banks. We saw the slowest rate of loan growth that we've seen actually declining for the first time since the lockdown periods of 2020. So in other words, the economy is unable to grow if small and medium-sized businesses, even large businesses, are unable to borrow, to finance working capital, to continue to expand, to invest in capital projects. But the banks are slowing lending, and companies are unable to borrow. Now, this to me looks a lot like the situation we saw in and before 2008. The regulators are refusing to really notice the gorilla in the room. We saw in the first quarter the number of problem banks increased, what they call problem banks, where they're concerned about their CAMELS rating, which is a combination of capital, assets, liquidity, all of the factors that they look at. And what we've seen is that now these troubled banks, problem banks, represent about 1.5% of the total banks within the system, and representing about 82 billion of assets. And at the same time, we're seeing that delinquencies and charge-offs are increasing, and this is largely, and we'll come onto this, driven by increasing defaults and delinquencies in credit cards and commercial real estate, where we now have seen the highest non-owner occupied commercial real estate charge-off rate, where the banks are just charging off these loans as no good, since 2012. Now, historically, it's worth to note that the FDIC, their problem list didn't really peak until 2 years after the global financial crisis had already exploded and was obvious to everyone. So the horse was out of the barn, and now then it was too late. And I'm concerned that we're in a similar situation. At that time, there were over 800 banks with 400 billion of assets that were ultimately put on the list. But again, 2 years after the crisis, when the crisis was essentially over. I mentioned that commercial real estate, and I've talked about this on the show before, has been a real sore spot for all the banks. There was a lot of concern about community and regional banks bearing the brunt of this, since they tended to lend into this asset class more. But it actually, if you look at the last quarter, it's the big banks, the too big to fail banks, that are seeing the non-current rate on their loans to, again, non-owner occupied commercial real estate. These are big buildings, office buildings, et cetera, in urban centers like New York, like San Francisco, that the non-current rate has jumped to 1.6%, which is the highest level in over a decade, since the fourth quarter of 2013, when a lot of the problems from the global financial crisis were still being worked out. But the big banks' past due and non-accrual loans to total assets have gone up to 4.5%, which is, again, the highest, and that's this green line right here. You see the rapid rate of acceleration over the course of 23. You have to go back to the global financial crisis years to see any kind of numbers like that. So this is, again, a warning sign that the banks are not okay, that there's more pain to come, and that this is a drag on the economy overall. So just quickly, we talked about this 2 months ago, but the equity markets continue to remain very high, near and setting new all-time highs. So the question is this time different, or is this a bubble, or is it something else? And one of the, I think, most basic and best statistics to really think about this is this so-called Buffett indicator, named after Warren Buffett, a favorite metric of his, which is to look at the aggregate value of the U.S. stock market, total market capitalization, and compare that as a ratio to gross domestic product. The idea is, okay, how much are U.S. companies worth versus how much the U.S. as a country is producing? It's not a perfect apples to apples comparison, because of course there are U.S. listed companies that have businesses around the world. GDP has a lot of things going on, but it is a good rule of thumb. It's a bit of a brute force one. And what you see in looking at this chart, thanks to currentmarketvaluation.com, that shows the historical trend line. This blue line reflects where we are. This slide now, as we come into the post-COVID years, which is this line here of 2020, we are now at the highest level ever, where at the end of April, the ratio of market cap to GDP was at 188%, almost double, compared with the historical trend line, which shows that it should be, let's say, even with the growth, around 100% maybe, but in the past, and it's hard to see the years here, but 2020, 2010, back to 2000, prior to those periods, the market value of the U.S. market was always less than our gross domestic product. And then in the period of easy money, that ratio began to change, where to now we are at this unbelievably high ratio of 188%, which they point out is 53% higher than the long-term trend. So this is, to me, the most basic way to say, is the market overvalued or not? The answer from this chart would be yes, it does appear to be so. Now, the question is, what's driving this? I did talk about this a couple of months ago. Just wanted to touch on a couple of things again. You know, there is the AI narrative out there. We've seen NVIDIA hit new highs above $1,200 a share. They're about to do a share split, but they have been on a tear over the past 3 years. AI is absolutely the theme. There's distortion in the market that it's really those large cap and especially AI companies that are performing when the rest of the market has been a bit of a laggard. But I think there's a couple of other things going on. So even at the end of the year, the market was beginning to realize that this may have less to do with how the economy is performing, but perhaps to do with all of the excess liquidity that is floating around in the markets. Again, the U.S. government is spending $1.7, $1.8 trillion in deficits each year. That money is flowing into the economy, into the banks, without necessarily a good place to go. And it's going into real estate, it's going into stock and equity markets. And the other factor, besides money supply expansion and excess liquidity, is inflation, that the market is anticipating that inflation is persistent, that it's not going to revert to 2%, let alone zero anytime soon, and that the equity markets are acting both as an absorptive power for all that excess liquidity and as a hedge against inflation. So let me go back up. If we look at this, you know, I made this comment a couple months ago, but I think I'm more convinced of it now than ever, which is that while the markets are overvalued today, this could last for a long time. As long as the market continues to expect rate reductions, which they do to some degree, and persistent inflation, and there is no systemic shock, nothing to crash the party, so to speak, these all-time highs in the equity markets, in Bitcoin, in meme coins, in housing, in gold, could persist through this year. And so the takeaway for all that is, I wrote a couple months ago about this idea of the Minsky moment, about this point in time where you get this wall of money rushing up, asset values go very, very high, very, very quickly, and then it pops. And that when that happens, as I wrote, that a soft landing after that is a fairy tale. We will not have a soft landing in that moment. If you haven't seen these videos or read my articles, you can check them out at stormwall.com and here on my YouTube channel to watch these previous episodes of the Stormwall Advisors Monthly Update when I cover the Minsky moment in detail and I talk about why a soft landing is a fairy tale. So having said that, maybe just to wrap up and come on to the takeaways, U.S. economic growth is underwhelming. GDP is weak and decelerating. The U.S. consumer is very strained. The labor market statistics are outright misleading. The data that shows when you actually look at it, the underlying work that Zero Hedge and others have done, low quality of job growth, low quality of wage growth, the headline numbers are masking that we're replacing higher paying full-time jobs with lower paying part-time jobs, and we're replacing U.S. workers with illegal immigrants. That is the true summary of the situation. The banks remain weak and under pressure. Lending growth is stalled. That is a limit on economic expansion, and the number of troubled banks are growing. The equity markets are disconnected from this. Whatever the reason is that they're at all-time highs, it is something other than growth in the economy. No doubt that AI, artificial intelligence, is real and transformative. The real driver here, however, is excess liquidity and inflation expectations as money supply expansion continues in what I've talked about here before, the deficit debt inflation doom loop. Check that one out as well at stormwall.com or here on my YouTube channel. And that we continue to be, as a country, as a market, as an economy, in danger of approaching our own Minsky moment, where markets are, at least on appearance, are in this last desperate and parabolic rise near the end of a long speculative run. Having said that, this could go on for a while. So I'm not predicting a market crash next week, next month, even this year. I do think these forces are extraordinary. I think it will end badly. But at the same time, I do see that these forces are very powerful that are keeping these markets aloft. And so there's more upside here for the time being. Nonetheless, if you don't want to be on that roller coaster, hard assets remain the only safe haven. Things like gold, oil, and other commodities, Bitcoin, real estate. If you have it, don't try to be buying it right now because it's too expensive. But if you own it and you can get yield, it's very inflation resistant, as are some of the equities that pay good dividends and are able to pass on inflation pressures to their customers. So thank you everyone for joining. I hope you found that helpful. If you want to learn more about Stormwall Advisors, you can check it out at stormwalladvisors.com. You see that up on the screen there. And all of my articles and all my videos are kept at my website, stormwall.com. And finally, here on YouTube, you can check out a lot of these topics that I've covered previously. If you're watching on YouTube, please don't forget to like it, to share it, to subscribe, turn on the notifications bell. These are good messages, important messages that more people need to hear. Happy June, everyone. We'll see you in another month here for the Stormwall Advisors monthly update for July. Right now, I'm signing off and wishing everyone all the best.